All right, so in this video, I want to break down the math to actually make millions in investing in real estate, whether it be short-term rentals or long-term rentals, whatever the case may be. You've heard about the vehicle, you know the investment strategy is there, but I want to go over the numbers specifically and how you can make millions when investing in real estate. So for simplicity, we're going to use easy to understand numbers. We're going to go based off of the idea of using a single family investment property. So single family, we have our one door here. And let's say this property is worth, or we purchased it for $100,000. On this $100,000 purchase, we need 20% down. On average, it could range anywhere from 15 to 20%, but let's use 20% as example. 20% down, which is going to be $20,000, leaving us with a loan balance or mortgage of $80,000. So this is going to be your loan or your mortgage that we are stuck with paying off over the course of a 30-year fixed period. So with this $80,000 mortgage that we have left on a $100,000 property, let's say we're charging our tenant rent every single month. They're going to be paying down the mortgage. But the first thing that comes out of this, your income or the rent minus all of the expenses, whether it is starting with your principal and interest or that mortgage, taxes, insurance, vacancies, maintenance, capital expenditures. If you're using a property manager, then your property management fees. After all of those expenses have been paid, let's say that this is generating a cash flow of $200 per month. On an annual basis, we multiply that by 12, it's going to give us $2,400 a year, which is great. A $200 cash flow investment, or $200 a month in cash flow, is going to equate to that $2,400 a year. This is a good number and something that we see very often. Now, the next big buzzword is appreciation. So we know that property values over time are generally going to increase and go up in value. So this $100,000 property, on average, is going to appreciate at about 3% a year. So after year one, the new property value of this property is going to be $103,000, giving you an additional equity of $3,000. So now we have your cash flow of $2,400, and we have built-in equity or natural appreciation of $3,000 in year one. After this, we also have loan paydown. So your loan paydown is your tenant paying rent to help pay down this mortgage. So let's say we had that $80,000 mortgage starting in year one. At the end of year one, this new mortgage payment is closer to $78,500, which means your tenant has paid off $1,500 or $1,500 towards that mortgage. So as the longer that the tenant is in place, if you remember this example here, property value goes up, our mortgage payment goes down, and everything in between is your equity. So in this, as time goes on, the 30-year mortgage that we have in place, that tenant is paying down your mortgage at $1,500 a year. Now this will go up more because as you pay down the mortgage, you're paying less towards interest and more towards the principal, but we'll cover that in a different video. So far, we have $2,400 a year in cash flow, $3,000 a year in appreciation, and $1,500 a year in loan paydown. The last one that I want to talk about is a tax benefit, also known as depreciation. And depreciation, this is the government allowing you to depreciate a single family residential property over the course of 27 and a half years. So with this, we take the value of the property, and generally they allow you to depreciate 90%. The reason for that is because you can only depreciate the property value and not the land. So in this scenario, 90% is going to be $90,000. Over the course of 27 and a half years, which gives you $3,272 a year in depreciation or tax benefits. All of this combined gives you a total income or revenue of $10,172. So not only are you receiving cash flow? Again, cash flow is great. We want to look for that because we don't want to be in the negative. We don't want to be paying for someone else to be in the property. So any bit of cash flow is good, but you can see how it's a very small piece of the puzzle when we look at all of the wealth that can be generated through real estate investing. This is the overall number. When we look at cash flow, appreciation, loan pay down, and depreciation, all of those things combined, you can start to see that bigger total in an annual revenue or income that now allows you to take this and either, if you're in a position now, to put those towards your personal expenses or to put this all towards more investment properties. So now you have multiple properties that are generating this number going up with time because your cash flow is going to increase because rent is also increasing. So every year you should see a substantial increase in this number, all while that equity is building, your debt is going down, and the property value is going up. I hope this helps and you find it somewhat helpful as just a general view of how millions are made in real estate and why I view it as such an important and a beneficial investment.